What if I told you that $5 a day, less than the cost of a coffee and a snack, could make you a millionaire? Not through some get-rich-quick scheme, not through crypto gambling or risky stock picks, through the most powerful force in all of finance. A force that Albert Einstein reportedly called the eighth wonder of the world, the compound effect. In the next 10 minutes, I'm going to show you the exact math behind how small daily actions create extraordinary wealth, and why the people who understand this principle end up rich while everyone else stays stuck. Here's why most people will never build serious wealth. They're chasing big wins. They want the stock that doubles overnight, the business idea that makes them $1 million in a year, the lottery ticket that changes everything. And while they're waiting for that big moment, they completely ignore the small daily actions that actually create wealth. The compound effect is the principle that small, consistent actions accumulate over time into massive results. It works in every area of life, but it is especially powerful with money. The problem is that compounding is boring in the beginning. When you invest $5 a day and after a month you have $150 with maybe a few cents in interest, it doesn't feel like you're building a fortune. So most people quit. They don't see the magic because the magic happens later, much later. But when it happens, it is absolutely extraordinary. Let's do the math, and I promise this will blow your mind. $5 a day is roughly $150 per month, or $1,825 per year. Now, if you just put that cash in a drawer, after 30 years you'd have about $54,750. Not bad, but not life-changing. But here's what happens when you invest that same $5 a day in the stock market, which has historically returned an average of 10% per year. After 10 years, you don't have $18,000. You have over $31,000. After 20 years, you don't have $36,000. You have over $114,000. After 30 years, you don't have $54,000. You have over $339,000. And after 40 years of investing just $5 a day, over $973,000. Increase it to just $6.50 a day, and you cross the $1 million mark. $6.50. That's what most people spend on lunch without thinking twice. There's a simple shortcut called the Rule of 72 that shows how powerful compounding is. Take 72 and divide it by your annual return rate. The result is how many years it takes for your money to double. At 10% returns, your money doubles every 7.2 years. So if you have $10,000 at age 25, it becomes $20,000 by 32, $40,000 by 39, $80,000 by 46, $160,000 by 53, $320,000 by 60, and $640,000 by 67. One single investment of $10,000 became $640,000, not through genius stock picking, but through the simple passage of time. This is why starting early is the single most important financial decision you can make. Every year you delay costs you exponentially more than you realize. But here's what most financial channels won't tell you. The compound effect isn't just about money. It works with every area of your life. Read 10 pages a day, and in a year you've read 12 books. In 10 years, you've read 120 books. That knowledge compounds into expertise, better decisions, and higher earning potential. Exercise 30 minutes a day. In a year, that's over 180 hours of training. Your health improves. Your energy increases, your productivity goes up, and your medical costs go down. Learn one new skill each quarter. After 5 years, you have 20 new skills. After 10 years, 40. Each skill multiplies the value of every other skill. A person who can write well, understand data, speak publicly, and manage projects is worth 10 times more than someone with just one of those abilities. The compound effect in your habits directly feeds the compound effect in your wealth. They're the same principle applied in different domains. Now let's talk about where to actually put your money so the compound effect can work its magic. Option 1. Low-cost index funds. This is the simplest and most reliable path. An S&P 500 index fund gives you exposure to the 500 largest American companies. It requires zero expertise, charges minimal fees, and has returned roughly 10% annually over the last century. Option 2. Dividend growth stocks. Companies that pay dividends and increase them every year create a double compound effect. Your investment grows in value while simultaneously producing income that you reinvest to buy more shares. Over 20 to 30 years, dividend reinvestment can account for over 60% of your total returns. Option 3. High-yield savings accounts and bonds for stability. While the returns are lower, having a portion of your money in stable assets prevents panic selling during market downturns. The compound effect only works if you stay invested. And you can only stay invested if your portfolio lets you sleep at night. Here's how you accelerate the compound effect and reach your goals even faster. First, increase your contributions over time. Start with $5 a day today. But every time you get a raise, increase your savings by at least half the raise amount. If you get a $200 per month raise, put $100 more into investments. You won't miss money you never had. Second, eliminate high-interest debt immediately. Credit card interest is the compound effect working against you. A $5,000 credit card balance at 20% interest becomes nearly $12,000 in 5 years if you only make minimum payments. Kill this negative compounding before it kills your wealth. Third, automate everything. Set up automatic transfers on payday. When saving is automatic, you remove willpower from the equation. You can't spend what you never see. Fourth, reinvest all returns. Dividends, interest, and capital gains should all be reinvested. The moment you start pulling money out, you break the compounding chain. Let every dollar earn more dollars, and let those dollars earn even more. Now let me warn you about the 5 mistakes that destroy the compound effect. Mistake 1. Starting late and trying to compensate with risk. If you start at 40 instead of 20, you might be tempted to chase high-risk investments to catch up. This usually backfires. Consistent moderate returns always beat inconsistent high-risk bets. Mistake 2. Pulling money out during market crashes. The stock market drops 30% and you panic sell. But market crashes are actually when the compound effect accelerates the most. You're buying assets at a discount. Every dollar invested during a crash works harder than a dollar invested at all-time highs. Mistake 3. Lifestyle inflation. You get a raise and immediately upgrade your car, your apartment, your wardrobe. The compound effect needs fuel, and that fuel is the gap between what you earn and what you spend. Mistake 4. Checking your portfolio daily. Compounding is a slow process. Watching it daily creates anxiety and temptation to tinker. Check quarterly at most. Mistake 5. Not accounting for fees. A 2% annual management fee doesn't sound like much, but over 30 years, it can consume over 40% of your potential wealth. Always choose low-fee investment options. The compound effect is not complicated. Invest a small amount consistently, reinvest your returns, avoid the common mistakes, and let time do the heavy lifting. $5 a day. That's all it takes to start building a fortune. The question is not whether the compound effect works. The math proves it does. The question is whether you'll have the patience and discipline to let it work for you. If you're ready to start building real wealth, subscribe to this channel and turn on notifications. Every video is designed to bring you one step closer to financial freedom. Drop a comment below telling me how much you're going to start investing daily. And I'll see you in the next one.